Welcome back to Money Talks, your guide to the Canadian Securities Podcast. I'm your host, Rita, and I'm so glad you're tuning in. A huge thank you to our loyal listeners for your incredible support. And if you're new here, welcome. Do us a favor and hit that subscribe button, leave a like, or drop a comment. It really helps us create valuable content to boost your financial education and career here in Canada. Okay, today we have a fantastic guest back with us, the brilliant financial professional, Jonathan Cartier. Hey, Jonathan, welcome back to the show. How's everything going in the market?
Hey, Rita. It's great to be back. Well, Canada's 2025 economy is in a bit of a reset mode. We're seeing some modest growth and inflation is easing up, which might lead to some rate cuts to fuel the rebound. Spending is strong, but the job market is cooling, and there's some uncertainty in trade, keeping the outlook mixed.
A reset mode. I like that. It sounds like a time for investors to be strategic, and maybe that's why alternative investments might be something interesting to consider. Could you talk about alternative investments, their benefits, structure, and risks?
Absolutely, Rita. It's the perfect time to explore this. In simple terms, alternative investments are anything that falls outside of the traditional buckets of stocks, bonds, and cash. Think of it like building a meal. Stocks and bonds are your protein and vegetables, the core of your plate. Alternatives are the spices and unique side dishes that can add flavor, balance, and new nutritional benefits to your diet.
That's a great way to put it. So, what kind of spices are we talking about here? Can you give us some concrete examples?
Of course, they generally fall into three groups. First, you have alternative strategy funds. A classic example is a long-short equity fund, which buys stocks it expects to go up and sells short stocks it expects to go down. Many Canadian firms specialize in these. Another strategy is event-driven, where a fund might invest in the company that's about to be acquired, trying to profit from the completion of the merger. Second, there are alternative assets. These are tangible things. Think of real estate, like owning a piece of a commercial tower in downtown Calgary, or investing in a Canadian real estate investment trust, or REIT. Or commodities, like gold mined in Ontario or oil from Alberta. And finally, there's private equity. This is where firms like Onex or Birch Hill Equity Partners in Canada invest directly into private companies, not ones on the stock exchange. They might buy a well-known retail chain, take it private to restructure and improve it, and then sell it years later for a profit.
Okay, so it's a pretty broad category. Why would an investor in Canada want to add these to their portfolio? You mentioned aiming for absolute returns. That sounds very different from just trying to beat the TSX.
It is, and it's a crucial distinction. The third major benefit, after diversification and adding alpha, is building an absolute return portfolio. The goal here is to generate a positive return over a specific period, say 12 months, regardless if the stock and bond markets are booming or busting. Traditional funds often aim to beat a benchmark, but if the benchmark is down 10%, beating it might still mean you lost 8%. Absolute return strategies aim for positive returns, period.
So how do you actually build a portfolio like that?
The key is to combine different strategies that have very low correlation to each other. For example, you might have a market-neutral sleeve, where long and short positions cancel out most of the market risk. You could combine that with a global macro strategy that bets on currency movements, and maybe an arbitrage strategy that profits from tiny price differences in related securities. The idea is that the success of these strategies doesn't depend on the overall market going up. So when your traditional stocks are down, these parts of your portfolio are hopefully generating positive returns, smoothing out your overall results. It's about creating multiple independent streams of returns.
This is fantastic, Jonathan. You're making a really complex topic so clear. I just want to take a quick moment to remind our listeners, if you're finding this conversation valuable, please subscribe and share this episode with your friends and colleagues. It helps us a ton. You can find Money Talks on Spotify, Apple Podcasts, YouTube, Podbean, Audible, and many other platforms. So, For everyday Canadian investors who can't meet the high minimums for hedge funds, you mentioned alternative mutual funds or liquid alts. Can you expand on those and maybe give an example?
Absolutely. Liquid alts are a game changer for retail investors in Canada. They're mutual funds that can use some of the sophisticated tools previously reserved for hedge funds, like short selling and leverage, but in a regulated and accessible format. This means you get daily liquidity, you can buy or sell them any day, and the transparency and investor protections of a normal mutual fund. For a hypothetical example, you might see something like the Innovate Canada Market Neutral Fund from a major Canadian bank or asset manager like RBC or Fidelity. This fund's goal would be to deliver steady, positive returns by buying what it considers undervalued Canadian stocks while shorting overvalued ones. The net effect is that its performance would depend on the manager's skill at picking stocks, not on whether the TSX Composite Index had a good or bad month. It brings that absolute return mindset to the everyday investor.
That sounds like a great option. Now, another structure you touched on was the fund of hedge funds. How does that work and who is it for?
A fund of hedge funds, or FOF, is essentially a way to outsource your due diligence and diversification. Imagine you want to build a house. You could hire the plumber, the electrician, and the carpenter yourself, vetting each one. Or you could hire a general contractor who finds and manages all the best specialists for you. A fund of hedge funds manager is that general contractor. You make one investment into the fund of funds, and that manager allocates your capital across a portfolio of, say, 10 to 20 different hedge funds, each with a different strategy. In Canada, you have firms that specialize in this, creating a curated portfolio of managers an individual investor could never access on their own. The big advantage is instant diversification and expert selection. But the downside is an extra layer of fees, since you're paying both the FOF manager and the underlying hedge fund managers.
That makes a lot of sense. Speaking of fees, you mentioned a term earlier, high watermark. This is unique to these kinds of funds. Can you break that down for us with an example?
Definitely. It's a crucial feature that protects investors. A high watermark ensures a manager only gets paid a performance fee on new profits. It prevents you from paying a bonus for the same performance twice. Let's walk through it. Say you invest $100,000 in a hedge fund. Year one, the fund does well and your investment grows to $120,000. That $120K is now the high watermark. The manager earns a performance fee on the $20,000 gain. Year two, the market is tough and your investment value drops to $110,000. The manager gets no performance fee because your value is below the $120,000 high watermark. Year three, the fund recovers and grows to $130,000. The manager can only charge a performance fee on the profit above the previous peak. So they get a fee on the $10,000 gain from $120K to $130K, not the full $20,000 gain during that year. It forces the manager to first recover your losses before they can earn a bonus.
That's a very fair system. Okay, last deep dive question. We've talked about market and strategy risks, but you also mentioned operational risk. It sounds less about the investments and more about the business itself. Can you give an example of what that looks like?
You've nailed it. Operational risk is the risk of loss due to failed internal processes, people, and systems. It's the risk without reward because it has nothing to do with a smart investment thesis. A famous study found over 50% of hedge fund failures were due to operational issues, not bad investments. A simple example is a fat finger trading error, where a trader accidentally adds a few extra zeros to a buy order, costing the fund millions. A more severe example would be a lack of oversight. Imagine a small boutique fund in Toronto, where one star manager is also the chief operating officer and the head of compliance. What happens if they make a critical mistake, or worse, engage in fraud? There's no one to catch it. A real-world example of this risk at its most extreme was the Bernie Madoff scandal, a massive fraud that went undetected for years because of a complete failure of operational controls. For investors, it means that you have to look beyond the great returns and ask, is this business run properly? Is there a strong back office? Are valuations handled by an independent third party? The plumbing of the firm has to be just as solid as its investment strategy.
Jonathan, this has been an incredibly insightful breakdown of alternative investments. You've given us a lot to think about, from the benefits of diversification and alpha to the various risks and structures available to Canadian investors.
My pleasure, Rita.
It's a fascinating and growing area of the investment world, and it's great that it's becoming more accessible.
Absolutely. And speaking of making things more accessible, I have some thrilling news for our listeners before we sign off. We've been paying close attention to all of your amazing feedback, your comments, the fantastic conversations happening on Reddit and other platforms. We've heard you loud and clear. So we've decided to launch our very own Money Talks website. This is going to be a game changer. It'll be packed with helpful features and resources designed specifically to support you. Whether you're just trying to get a better handle on these complex financial concepts we discuss, or you're deep in the trenches studying for your CSC exam or the upcoming CIRO exams, we're building this for you. We'll keep you posted on the exact launch date very, very soon, so stay tuned. Okay, now that's all the time we have for today. A huge thank you once again to Jonathan Cartier for sharing his expertise with us, and a massive thank you to our wonderful audience for listening and for inspiring us to grow. Join us next time on Money Talks.